How does COGS affect corporate profit margins? Have you ever wondered how the costs of making products impact a company's profits? Let's break down the relationship between cost of goods sold and corporate profit margins. Cost of goods sold, often referred to as COGS, includes all the direct costs tied to producing goods or services that a company sells. This means it covers expenses like raw materials, labor, and manufacturing overhead. Profit margin is calculated by taking the difference between sales revenue and all costs, including COGS, and dividing that by sales revenue. When COGS rises, profit margins can shrink unless companies increase their sales prices accordingly. This is especially true during inflationary times when costs for raw materials, energy, and labor tend to go up. Inflation can put a lot of pressure on businesses. As input costs rise, COGS increases, which can squeeze profit margins. Companies face a tough choice: absorb the higher costs or pass them on to consumers through price increases. If they choose to keep prices the same, their profit margins will likely decrease. Interestingly, some companies manage to raise prices even more than their increased COGS. For instance, during the recovery period after the pandemic, many businesses used their market strength to hike prices beyond what their costs had risen. This strategy can actually lead to increased profit margins. However, this practice can also contribute to inflation, as higher prices for consumers can push overall costs up, even when input costs stabilize or drop. In some situations, corporate profits have accounted for a significant portion of inflation, showing that profit margins can expand despite rising costs. Companies that have strong pricing power can maintain or even grow their profit margins by raising prices. On the other hand, businesses with less pricing power may struggle to pass on all cost increases, leading to lower margins. This dynamic is essential for understanding how COGS, pricing strategies, and profit margins interact, especially during inflationary periods. When inflation drives up COGS, companies with the ability to adjust prices can protect their profit margins. In contrast, those without that power may face declining margins, which can affect overall profitability and market performance. So, the next time you think about how businesses manage their costs, remember that COGS plays a vital role in shaping corporate profit margins, especially in the context of inflation and its broader economic impact.